guys, welcome to Talking Money with Nozi, personal finance made simple. Today, I'm going to be talking about how you can build a monthly dividend portfolio using ETFs and shares that pay dividends in different months of the year. Again, today's video is about the US stock market, the New York Stock Exchange. The New York Stock Exchange is so huge and it makes it very, very easy to build a nicely diversified monthly dividend portfolio using different shares as well as ETFs. There are hundreds and hundreds of stocks and ETFs that pay dividends on the US stock market. So where do you even start looking? How do you even begin to choose? Well, personally, I start by looking at two lists of dividend stocks called the Dividend Aristocrats and Dividend Kings. So what is a dividend aristocrat? A dividend aristocrat is a company that is part of the S&P 500 index that consistently pays dividends to investors for at least the past 25 years. Dividend aristocrat companies usually have products that are resistant to the effects of recessions as well as inflation. This allows them to keep making profits and paying dividends even while other companies are struggling. Currently, there are just 65 dividend aristocrats from many sectors, including healthcare, retail, oil and gas, as well as construction. Let's have a look at the list of the 65 dividend aristocrats. All right, guys, if you just simply Google dividend aristocrats, you will find all sorts of links with the list of the 65 dividend aristocrats. So it's very, very easy to find them. Here is the list from this website, money.usnews.com. Number 1 is 3M. Number of years of dividend growth is 64. A.O. Smith, 29 years. Abbott Laboratories, 50 years. AbbVie, 50 years. Aflac, 39 years. Air Products and Chemicals, 40 years. Albemarle, 28 years. Amcor PLC, 39 years. Archer Daniels Midland Company, 48 years. Atmos Energy Corp, 35 years. Automatic Data Processing, 47 years. Becton Dickinson and Company, 50 years. Brown & Brown Inc., 28 years. Brown Forman Corp., 38 years. Cardinal Health Inc., 35 years. Caterpillar, 28 years. Chevron, 35 years. Chubb, 29 years. Church and Dwight, 26 years. Cincinnati Financial, 62 years. Cintas, 38 years. The Clorox Company, 48 years. The Coca-Cola Company, 60 years. Colgate Palmolive, 60 years. Consolidated Edison, 48 years. Dover Corp, 66 years. Ecolab Inc., 30 years. Emerson Electric Company, 60 years. Essex Property Trust Inc., 28 years. Expeditors International of Washington Inc., 28 years. ExxonMobil, 38 years. Federal Realty Investment Trust, 50 years. Franklin Resources, 41 years. General Dynamics Corp., 31 years. Genuine Parts Company, 66 years. Hormel Foods, 56 years. Illinois Toolworks, 51 years. IBM, 26 years. Johnson & Johnson, 60 years. Kimberly-Clark, 49 years. Linda PLC, 29 years. Lowe's Companies, 48 years. McCormick & Co., 36 years. McDonald's Corp., 45 years. Medtronic PLC, 44 years. Next Era Energy, 26 years. Nucor Corp., 49 years. Pentair, 45 years. People's United Financial Inc., 29 years. PepsiCo, 49 years. PPG Industries, 50 years. Procter & Gamble, 66 years. Realty Income Corp., 27 years. Roper Technologies, 29 years. S&P Global Inc., 49 years. Sherwin-Williams Company, 43 years. Stanley Black & Decker, 54 years. Cisco Corp., 42 years. T. Rowe Price Group, 36 years. Target, 50 years. VF Corp., 50 years. WW Grainger Inc., 51 years. Walgreens Boots Alliance, 46 years. Walmart, 49 years. West Pharmaceutical Services, 29 years. I will leave the link to this website in my description so you can come and check out this list of dividend aristocrats for yourself. Now, let's talk about dividend kings. What is a dividend king? Dividend kings are companies that are known for increasing dividend payments for a minimum of 50 years. 50, guys. Some dividend kings can also be dividend aristocrats, meaning they've been paying dividends for the last 50 years and they are also part of the S&P 500 index. let's have a look at the list of dividend kings. Alright guys, next is the list of dividend kings. And because dividend kings have achieved such a rare thing, increasing dividend payments for 50 years or more, there are obviously fewer dividend kings compared to dividend aristocrats. So here is the list of dividend kings. Again, I'm going to leave a link to this website in my description below. We've got the company name, the sector, as well as the consecutive years of dividend increases. So we've got American States Water, 67 years, Dover Corporation, 66 years, Northwest Natural Holding, 66 years, Genuine Parts, 66 years, Emerson Electric, 65 years, Procter & Gamble, 65 years, Parker Hannifin, 65 years, 3M, 64 years, Cincinnati Financial, 62 years, Coca-Cola, 60 years, Colgate-Palmolive, 60 years, Johnson & Johnson, 59 years, Lowe's, 59 years, Lancaster Colony, 59 years, Nordson, 58 years, Farmers and Merchants Bancorp, 58 years, Hormel Foods, 56 years, California Water Service Group, 55 years, Stepan, 55 years, Stanley Black & Decker, 54 years, Federal Realty Investment Trust, 54 years, SJW Group, 54 years, Commerce Bank Shares, 54 years, ABM Industries, 54 years, Cisco, 52 years, HB Fuller, 52 years, Altria Group, 52 years, Black Hills Corp, 51 years, National Fuel Gas, 51 years, Universal Corporation, 51 years, WW Granger, 50 years, PPG Industries, 50 years, Target, 50 years, Abbott Labs, 50 years, AbbVie, 50 years, Becton Dickinson & Co., 50, Kimberly-Clark, 50, MSA Safety, 50, Tennant, 50, Nucor, 50, and PepsiCo, 50. Basically, the dividend aristocrats as well as the dividend kings are quality dividend companies, quote unquote, the cream of the crop, because they have managed to increase their dividends for more than 25 years for aristocrats and more than 50 years for kings. So now that you have a list of these dividend aristocrats and kings, how do you actually choose which ones to buy? As always, dividends are not the only thing that you should look for when you are choosing your investments. As I mentioned in last week's video, you have to look at things like revenue growth, profit growth, reasonable debt levels, as well as free cash flow. If you missed that video, please click on the link which is appearing on your screen right now to watch that video. Then you can come back to this video and watch it afterwards. There are also other dividend stock qualities that you should look for, such as the dividend growth, dividend quality, and lastly, the dividend yield. So what is dividend growth? Dividend growth is also known as the dividend growth rate. This is the percentage growth of a company's dividend. While dividend aristocrats and kings have a history of growing dividends for 25 years or more, they do not all have the same dividend growth rate. Some companies grow their dividends at a higher rate than others, and obviously you should try to find companies with the higher dividend growth rate. What about dividend quality? The dividend quality is measured by the dividend payout ratio, which is the ratio of the total amount of dividends paid out to investors compared to how much money a company earns. If a company has a payout ratio higher than 100%, it usually means their earnings don't support the size of the dividend. If a company has a lower dividend payout ratio, it means that the dividend is supported by a company's earnings and there is less risk that the dividend will be reduced or start in the future. Lastly, let's talk about the dividend yield. The dividend yield shows how much a company pays out in dividends each year compared to its share price. You use the dividend yield to calculate how much you will earn in dividends. For example, if a company has an annual dividend yield of 10%, it means if you invest $200, you will earn $20 as dividends. But dividend yield is the last thing you look at after checking revenue, profits, debt levels, cash flow, dividend growth, as well as dividend quality. Don't make the mistake that many new investors make of rushing to look for high dividends before checking more important things. I would rather buy a good company with an average dividend yield than a bad company with a very high dividend yield, because a bad company paying a very high dividend is just a trap, and it's only a matter of time before the dividend is reduced or stopped completely and before you lose money. Alright guys, this is my Dividend Aristocrat spreadsheet that I downloaded from the internet. I'm going to leave the link in my description where you can also download the same spreadsheet. So this spreadsheet shows you all the 65 Dividend Aristocrats. It shows you the ticker symbol. When you're searching on the stock market, it's easier to search using the ticker symbol. This is the full name, sector. Guys, when you're investing, don't buy shares from the same sector. You need to mix it up. Another thing you'll see is the dividend yield. You also see the years of dividend increases. Then there's also the 1-year dividend growth, the 5-year dividend growth. This is what I look at. I want to see how the companies have been increasing their dividend. Also, besides the dividend growth, I also look at the payout ratio. So remember I said the payout ratio is really a measure of how safe the dividend is. And if a company is paying out too much of its earnings as dividends, I get worried, because money that a company pays out is money that they can actually be using to invest in themselves and to grow the company. So if they're paying way too much in dividends, then it means they are investing very little back into the company, and that's a worry for me. So because I'm a little bit conservative, I like the payout ratio to be 60% or lower. What I do is I sort the 5-year dividend growth from largest to smallest, because I want to see which ones have got the biggest dividend growth over 5 years. And you can see AbbVie has got the highest with 17.1%, followed by T-Rowe, and then followed by S&P Global, followed by AOS Smith Corp, followed by Lowe's, then Automatic Data Processing, then Abbott Laboratories, then Air Product and Chemicals, then Illinois Toolworks. But guys, the dividend growth is not the only thing that I look at. You also have to check the revenue, your cash flow, earnings per share. You combine with the other financial metrics before you make your decision. This is the spreadsheet for the Dividend Kings. Again, I'm going to leave the link where you can download the spreadsheet from. You will notice that there are 44 Dividend Kings, and you'll notice that some of these names are familiar. You've seen them in the Dividend Aristocrats. Remember in the beginning of the video, I said some Dividend Kings are also Dividend Aristocrats. Dividend Aristocrats are companies that have been increasing dividends for 25 years or more, and they belong to the S&P 500 index. So you will see some of the names repeating. Again, I come to the 5-year dividend growth and order by large to smallest so that I see which companies have got the highest dividend growth. Dividend yield for me is not the number one criteria. I rather look at other things like the dividend growth, the dividend payout ratio, earnings, revenue, profit, cash flow. So once I order by 5-year dividend growth, again, number 1 is AbbVie, number 2 is Parker Hannifin Corp, number 3 is Lowe's, number 4 is Abbott Laboratories, number 5 is Notson, then SJW, then Illinois Toolworks, etc., etc. So I use this spreadsheet to gather the shares that could be potential. I won't jump and buy them immediately, but then I make a list from the Dividend Aristocrats, Dividend Kings, then I look at all the other financial information, and then from there make a decision. Now let's talk about dividend ETFs. For those that don't know what ETFs are, the simplest definition of ETFs is that they are groups of many shares sold on the stock market as one product. So if you buy a dividend ETF, you are buying a group of many dividend shares in one product. The advantage of ETFs is the automatic diversification that they give to investors. Also, when a company no longer qualifies to be part of the ETF, it is removed from that group and replaced by a better company on your behalf. ETFs are a safer and stress-free way of investing on the stock market. Okay guys, I'm going to show you 3 ETFs that focus on strictly dividend paying companies. So this is my Easy Equities account. I logged in on the website, clicked on Easy Equities USD and select invest now. Then click where it says select investment type, ETFs. So I'm going to start with an ETF called DVY. DVY is this one. It's the iShares Select Dividend ETF. When I click on Yahoo Finance, this is what you're going to see. You will see the dividend yield, which is 3.42%. You also see the expense ratio, which is the cost of owning the ETF, which is 0.38%. Inception date was 2003. Then you can also check the performance. So you can see for the last 10 years, it has returned 11.37%. Over the last 5 years, it has returned 9.11%. If you want to know what this ETF is all about, just copy the name and search for it on Google and then open the website. This is what happens when I search for DVY on Google and click on the link. So firstly, it shows you the expense ratio, which you've already seen, 0.38 on Yahoo Finance. Then it also shows you the overview. Why DVY? It says, number one, this ETF gives you exposure to broad cap US companies with a consistent history of dividends. Number two, it gives you access to 100 US stocks with 5-year records of paying dividends. Then you can also see the section that says performance, where you can see how it has done. So total return is the performance including dividends, and for the last 10 years is 11.39%. You can also see distributions, which is when they pay dividends. So if you want to see the history of the dividend payments for this ETF, you click on view full table, then you'll see all those dates. Then when you keep scrolling, you will see the companies that are in this ETF, and these are the top 10, with IBM at number 1 position and International Paper at number 10 position. You can click on the following pages to see more of the companies that are in this ETF. Let's move on to the next ETF, which is Noble, N-O-B-L. ProShares S&P 500 Dividend Aristocrats ETF. So the name is telling us what this ETF is all about. So you click on Yahoo Finance to see a few statistics. So you see that dividend yield for Noble is 1.89%. The expense ratio, the cost of owning this ETF, is 0.35%. Inception was in 2013. Again, look at performance. We see that there's no stats for 10 years. There's only stats for 5 years. So for the past 5 years, it has returned 9.99%. Again, you can go to the website of the actual ETF. So you copy the name, go to Google and open Noble. This is the page that opens when I search for Noble on Google and click on the link. Why invest in Noble? It says this is the only ETF focusing exclusively on the S&P 500 Dividend Aristocrats, high quality companies that have not just paid dividends but grown them for at least 25 consecutive years, with most doing so for 40 years or more. So it's just telling you that this ETF specializes in dividend aristocrats. Next, what you'll see is the performance of the ETF. So the total return for the last 5 years was 10.49%. There's nothing for 10 years because the fund started in 2013, which is 9 years ago. Next, you will see about the fund. Number of companies is 64, which is more or less the number of dividend aristocrats currently. Dividend yield is 1.54%. Expense ratio is 0.35%, as we've seen. And it says distributions of the dividends is quarterly, meaning they pay dividends 4 times a year. If you keep on scrolling, you will see the top 10 companies within this ETF, starting with Nucor. The last ETF that I'll show you is SCHD. So let me click invest now. ETFs, type SCHD. SCHD is the Schwab US Dividend Equity ETF. Again, click on Yahoo Finance. You will see here dividend yield is 3.44%. Expense ratio 0.06%. So far, it's the cheapest of the 3, and inception date was in 2011. Performance. For the past 10 years, it has returned 13.5%. Over the last 5 years, it has returned 13.03%. Again, to know what this ETF is all about, you can actually go to the website, copy the name, paste it in Google. When I look for SCHD on Google, I click on the link. This is what opens. You can see the expense ratio is 0.06%, as we've seen already. The objective, it says the fund's goal is to track as closely as possible before fees and expenses the total return of the Dow Jones US Dividend 100 Index. Then to read further about this ETF, I clicked on SCHD prospectus and other regulatory documents. So if I click that, this page will then open. Then it says principal investment strategies. To pursue its goal, this fund, which is SCHD, generally invests in the stocks that are included in the Dow Jones US Dividend 100 Index. This index is designed to measure the performance of high dividend yielding stocks issued by US companies that have a record of consistently paying dividends, selected for fundamental strength relative to their peers based on financial ratios. Then it says all index eligible stocks must have sustained at least 10 consecutive years of dividend payments, have a minimum float adjusted market capitalization of $500 million. This just means the size of the company must be 500 million or more. The index components are then selected by evaluating the highest dividend yielding stocks based on 4 fundamental characteristics. Number 1, cash flow to total debt. Number 2, return on equity. Number 3, dividend yield. And number 4, 5-year dividend growth rate. Lastly, I'm going to use Google Finance to compare the performance of the 3 ETFs over long term. So just go to Google, type Google Finance and click on that first link which appears. So over here where it says search for stocks, ETFs and more, I'm going to type DVY, this one, and select 5Y for 5 years. Then where it says compare to, I click and type in NOBL, select that one, add comparison SCHD. So you can see the 3 graphs showing the movement in the price of these ETFs over 5 years. And you can see that SCHD has outperformed Noble and DVY. SCHD has grown by 56.45%, Noble 46.84%, DVY 26.46%. If I click on max, it actually stretches out the graph to show since inception, since these ETFs started, how have they done. And again, you can see SCHD is leading, then followed by DVY, then lastly Noble. For me, SCHD is my ETF of choice because number 1, it is low cost. Remember, the expense ratio is 0.06%. Number 2, I like the long-term performance that it's showing so far. And number 3, the dividend yield is not bad. As an investor, you can research and choose individual dividend stocks, or you can choose to buy an ETF that holds dividend stocks. Personally, I would rather have a mixture of both shares and ETFs in my portfolio, with a higher allocation of my money going to ETFs. For example, about 80% of my money goes to ETFs and only 20% to individual shares. Having a mixture of ETFs and individual shares is the less risky option because ETFs are managed on your behalf, and the chances of you losing all your money are very minimal because ETFs give you that automatic diversification. You buy one ETF, but it covers many different companies, and the chances of those many companies going out of business all at the same time is very minimal. Let's have a look at an example of a dividend portfolio that would pay you dividends every month from January to December. The key word here is example, guys. These are definitely not recommendations of which shares or which ETF to buy. Please do your own research before you invest in anything. Alright guys, this is the spreadsheet that shows you an example of a monthly dividend portfolio that you can set up. So PepsiCo is a dividend king as well as a dividend aristocrat, and it has had 50 years of dividend increases. Illinois Toolworks is a dividend king as well as an aristocrat with 58 years of dividend increases. Medtronic is a dividend aristocrat with 45 years of increases. Altria is a dividend king with 52 years of dividend increases. increases. Abbott is both a king and an aristocrat with 50 years of dividend increases. AbbVie, king and aristocrat, 50 years of increase in dividends. Procter & Gamble is also a king and aristocrat with 66 years of dividend increases. Johnson & Johnson is both a dividend king and aristocrat with 60 years of dividend increases. Target, it's a king and an aristocrat with 51 years of dividend increases. Lastly is McDonald's, which is an aristocrat with 46 years of dividend increases. So what I did is I color coded these companies. So PepsiCo is green and Illinois Toolworks, Medtronic and Ultra are yellow. This group is orange and this group is pink. The reason why I color coded them is because they pay dividends 4 times a year. So they repeat. PepsiCo, which is green, will pay you a dividend in January and then in March, then in June, and lastly in September. Then this yellow group, which is I'll call it the Altria group, will pay you dividends in January, then it repeats in April, repeats in July, and then in October. The orange group, which is your Abbott group, will pay in February, then again in May, then in August, then in November. Then lastly, you will have your pink and green. PepsiCo is a bit odd because PepsiCo pays in January and then it repeats again in March. It's weird, but PepsiCo and these guys will then repeat in June, repeat again in September, and lastly in December. So this is an example of how you earn dividends from January right up to December using a mixture of ETFs as well as dividend aristocrats and dividend kings. Okay guys, that's it for today's video. If you enjoyed this video, please show some love and hit the thumbs up button and subscribe to my channel. Next week, I'll be speaking about setting up a monthly dividend portfolio on the JSE, the Johannesburg Stock Exchange. Bye guys, see you next week.